Okay, good morning once again, guys, and thanks for joining me here on the lesson number 5, risk. Risk, one of the most important things for me, the second most important thing after psychology. It's a big deal for retail traders. It's seemingly it's a smaller deal for retail traders. I think it's because maybe they are opening accounts like $100 or $1,000, so it's not the end of the world if they lose that. So risk is not that important to them. I think as soon as the money becomes, or when the accounts are, maybe if the accounts are growing or they've put a bigger deposit in there, then it becomes more important. The thing is, this is what hedge funds already do. They are already trading money that's not their own, and it's a huge sum of money. So there's an importance that is attached to risk, whereas retail traders have that importance is not there yet. So we need to try and get this as soon as possible. Try and have the feeling that it's real and it's not it's not a game. They've probably gamified this trading a lot now, and it's stuck with retail traders now. So the only way around this issue is to attach the importance to this subject that it deserves. Yeah. So risking. The standard amount of risk and all that, we need to try and get rid of the basic idea. We need to not risk too much and also not too little. In books and online courses and YouTube, we will find the figure is a certain amount between 1% and 2%. But that is not ideal for everyone. It might be ideal for some. So what we're trying to do is to find this balance, not too much and not too little. But in the beginning, as we are starting to trade, we need to keep this training wheels on. So risk as low as possible in the beginning so that you can be sure that you know what's going on in the strategy. So you're risking 0.1 lot size even until you get 10%. And then this way you are guaranteed that you know the strategy, and you didn't have just a one lucky trade. Like if you trade 2% and you let the trade run and it worked out, then that's all you need to know. Yeah, you've done it. You've made 10%. But the issue is we've only seen one trade. So what we're trying to do here is trade a low risk so that you can gain 10% low risk. And then we have a series of trades. We can see the nature of how you're taking trades, and we can see that you are now finally being able to stick to a strategy, through thick and thin, because there will be times of up and down during that phase of while the training wheels are on and while you are still risking very low. So the lowest lot size until you reach 10%. Like I would suggest, nothing more than 0.5% really per trade idea. But the lower the better, because the more trades you use to get this 10%, the better you will be at your strategy. The one size fits all, the 2%, that's not going to cut it here. So we're going to, cut that piece out. We're going to use theories from Zurich Axioms, by Max Gunther. Says worry is not a sickness, but it's a sign of health. If you are not worried, you're not risking enough. So retail traders will be a bit happy to hear this, because you get the two schools of thought. The one that says you need to risk very, very low. That's what I'm trying to show you just in the beginning here while the training wheels are on. That's the very low risk, not exciting at all. And then you get the other side of the field where we are we want to gamble. We want to make a lot of money quick. And then, all you need is one trade and then you can retire. So it's the two spectrums there, the very low risk, the boring style, or the very exciting one. So Zurich Axioms is trying to give you that balance that we're looking for. What is the correct amount for us to risk? What I'm going to suggest is during your day, find out what it is you are consuming and how much that costs. A cup of coffee, the burger, the drink, the pizza, whatever you have during the day, and divide that by 3. And then I think you will get your basic average on what it is you should be risking. So every time you're taking a trade, you're risking that next cup of coffee, or you're risking that burger or the drink or whatever it is. It's not too little that you don't care about it, and it's not too much that it's going to be, that you can't sleep at night while the risk is on. Yeah, so try this and see if this sort of a thing will help you balance out the amount that you're supposed to be risking. Our personalities also plays a major role, not only with the risk, but the type of trades we're going to take. During this last session, I'm going to explain how the personalities can affect us and what sort of traders we are. And then that personality is also going to determine the size that you're going to take eventually. But we need to be managed here. In a hedge fund, the risk managers are managing our risk for us. Yeah. But when we are trading as a retail trader, then you are doing the trading as well as the managing. So that combination usually ends up in a disaster. So some sort of risk. This is why for the homework, you're going to do a risk management plan, a trading plan, and then present the plan to the group, and then hopefully that keeps you accountable. You've proclaimed this. This is what you've proclaimed inside your plan, and you've said it to all of us in the group. Hopefully it's going to keep you more accountable as to the sizes that you take, the risk sizes. So we are going to plan. That's going to be the way that we're going to try and keep us on the right track where risk is concerned. Not that we are at the chart and we don't know. First of all, we don't know if we're going to take the trade. And then second of all, we don't know how much we're going to risk. So we're just adding more and more factors of the unknown. And that becomes, a point where you're completely stuck. Yeah, it's a difficult situation, this trading. So planning is going to help us with, the amount we're going to risk and whether we should take the trades or whether we should just leave the trade. So the plan should start with something like this. First of all, we need to adhere to the fact that the zones are not made equal. Yeah. For support and resistance, if you find you are trading better at support and resistance instead of trading on a trend line, then add more value to the support and resistance as opposed to the trend line. If you are trading 0.5% as a standard risk, then trade 0.5% here at this level. And then a trend trade, you adding less value, then trade this at 0.25, half of your standard risk. Zones are not made equal. I might find the trends better and I might swap it around. I might say, for me, when I trade on a trend, I'm going to use my full standard risk. And when it hits the zones here, I will half my risk. So it all depends on how you feel at these levels. Yeah. Hopefully by now you would already have a feeling on which of these you like the most. Also, the zones are not made equal with the time frame. If this is a daily zone, then add more value to that. If it's a weekly zone, add more value. As soon as we're dropping the time frames, like if this zone is found on a 5-minute chart, then drop your risk. You don't need to not take the trade, completely. It's still a support level. If prices is hit here and it fulfills all the rules, just lower the risk as the time frame goes down. This is what needs to be included in the plan. Do you trade the support and resistance? And if so, what is the risk that you attach to that support and resistance? And I would suggest lower the risk as you lower the time frame. The other thing is zones are not made equal due to confluence. So if you see a static line here and it's a nice area, it's a nice zone, and also you have an EMA as confluence, then you can add more value to that. You feel more comfortable. So the feeling, the personalities that comes into play when you feel more comfortable at the zone, and you will know this because you've been doing the same thing over and over and over again. So by now you should know what it is you like and what it is you don't. So add more value to what you feel is more profitable for you. It might be different for all of us in the group there. Yeah, some people likes the 5-minute chart, but then they're going for a much smaller target, and that's up to them. But then just add less value at that zone. So the higher the time frame, the more confluence, the more you can risk, but still you need to have a cutoff. So the higher the time frame, the higher the confluence, you add more risk, but there is a cap to this. So for me, depending on your personalities, and obviously the amount of money you're going to trade. Again, if you're starting off with $100 and it means nothing to you, then you're gonna want to you're gonna want to risk more of that money. Yeah. So it all depends. It's not just a 1 + 1 is equal to 2 sort of a thing. It's you have to take time. This is why the guys in the group, the longest gap between the assignment given and the homework done was this one. We're still waiting on the first group of people to complete this section, and that's fine. That shows me that they are taking their time with this very important step. Yeah. So for me, if you are an aggressive trader, I still won't even trade more than 0.5% on a trade idea. That's this year, 0.5% on that trade idea there. And then a conservative trader, the most is 0.2%. Now, these are just my guidelines here. Yeah, if you are 1% guy here, then that's fine. But the idea is, as soon as the quality of the trade goes up, that it reaches your maximum. As soon as the quality of the trade goes down, then you are trading less. So less confluence, lower the time frames, then we are heading toward our bottom area here, the lower spectrum. Yeah. So the first step is to find out if you are an aggressive trader or if you are a conservative trader. That's step number one. What's your personality like? Yeah, can you handle the higher risks for your account size? And then once you know this, don't ever go beyond that. And then as the quality of the trade goes up and down, you lower your risk based on that. Okay, and then there we go. Now, this is scalping. And scalping is not a complete no-no. Yeah? There are people that scalps very, very well. There is different risk parameters for the scalping though. Yeah. So when we scalp the market, we're going to want more than 1.25 R here. So we're risking 1 to gain 1.25. We want to try and steer away from the 1:1. I'm going to show you what I mean with scalping soon. So 1:1, now you need a 50% win ratio sort of a thing. And then you're breaking even, yeah? And scalping, you're going to lose more than... it's going to be more like a 50-50 sort of a thing. That's just the nature of it. You're going to take a lot of losers as you are scalping. Yeah. So the idea of moving toward just slightly more than 1:1 is going to be better for you. So even if you do get a 50% win ratio, you're still going to end up profitable in the end. Yeah. But scalping is really more like the dice. It's more of a 50-50 sort of a game. Yeah. It's very simple. Let me just explain with a drawing. Because everything is random in the market. Yeah, we don't know whether it's going to go up or down at any particular point. The only thing we are trying to do is tilt the edge in our favor. Yeah, that's all we're trying to do. So it's always going to be a 50-50 game. So for a 1:1, yeah, this is what it looks like. So if you are going to risk more, say you're going to risk up to this point here, that's your risk. That entire piece is your risk. Let me just change the color here. Let's say this entire piece now is my risk. This whole section here. I'm risking that to gain just that piece there. So this is 5 pips perhaps, and this whole piece that I'm risking here is 50 pips to get 5 pips. Now my win ratio is just naturally going to go up. You're going to win more of the time here. That is all this game is all about here. And then if this part was if this part here is what you're now risking, you're only risking that to gain a much bigger section. So in this case, you are risking 5 pips here, but to gain a whole 50. So now your win ratio is going to go down. That's just the whole thing. Yeah. So usually when we are scalping, it's just really more of a 50-50 sort of a thing. Yeah. So aim for more than 1:1. Aim for 1:110, or just anything more than 1. So that is then your edge. Your edge is you always aiming for slightly more, including your spread and the cost and all that involved. Just make sure that when you are winning, you're winning slightly more than what you are losing. That is what scalping is all about. Nothing more than just that. Yeah, you're going to get an 80% win rate, 90% win rate if you're going to risk 100 pips to gain 2 pips. Yeah. 100 pips to gain 2 pips. You're going to get a 98% win rate there. Yeah. But that doesn't matter, because that's not going to keep you profitable over the long run. Yeah. But just look at how this works on the psychology now. You feel, wow, I am 98% profitable. But being right is not being profitable. Yeah. We need to risk properly to be profitable over the long run. So let's try and forget about the idea of the win rate is everything. Yeah. Let's just move on to the next one. So when we're scalping, when do we scalp? I'm scalping on two reasons. One is when I'm going against my fundamental bias. Yeah. So prices are, let's give it a proper example quickly. Prices are coming down on the euro versus the dollar. I am bearish on this pair because I am definitely selling the euro. Yeah. Now it comes to the edge here. Yeah. And it creates a nice setup. Now this here is where I go into scalping mode because it's against my fundamental bias. I'm going to buy, but I'm not planning to hit my target up here. I just want to scalp this area. And when I do this, when I'm going against my fundamental bias, I'm just giving you an insight as to what I do. Yeah, I'm not saying you need to do this. I do this. It makes me feel comfortable. Yeah. I know traders who's not gonna take a beautiful setup here because it's against the fundamental. Yeah. And I've missed out on many, many great looking trades because of a stubborn fundamental bias. Yeah, because I'm very stubbornly selling the euro. Yeah, really. But when it gets there, I am risking low. Yeah, my lowest spectrum. And I am doing it as a scalp, which means I am going for anything more than 1:1. I'm going for something like 1:1.10, 1:1.25 is my favorite one when I'm going against my fundamental bias. Just not to miss that. So if this trade doesn't work out, I feel I'm still happy because I've risked low. And I am I'm happy because I'm only going for this 1.25. Yeah, I'm not going for my standard risk. I'll show you that a bit later as well. Yeah, so that's one reason I will scalp. Yeah, I call it scalping when I'm going against my fundamental bias. Scalping is a small, minute piece that I'm trying to take from the market, and it's not my standard trading style at all. Yeah, and I don't really feel like scalping. It's just when it presents itself. It presents itself when I'm not trading with my fundamental. I'm against my fundamental, but the setup looks beautiful technically. And then there's another reason when I scalp. Yeah, so it's my fundamental bias I'm trading alongside my fundamental bias in this example. Yeah, I'm alongside my fundamental bias, and here we go. This is a target up here. Yeah, and prices has come up and it's done all its necessary stuff here. Yeah, now I'm going to scalp from this point if I find setup because my target is so close by. So I'm back into scalping mode. I'm looking for 1.1 or 1.25 or 1.10, anything more than 1:1. Because I am this late to the party, that's my target up there. I already took my trades here. I'm smiling down here already. I've taken what I need to take and I've did everything during this process there. And when it got here, I became less happy about the trade. I started dropping down my risk. The setup was beautiful. Dropped down my risk because how late I am to the party. Yeah, that's my target up there. So this is when I go into scalping mode. 1.25, a little bit more than 1:1. This is just an insight to what I do. Yeah, this is more of my sort of plan. Copy it if you want. I find it useful. Because I think all of us retail traders really started off with a scalping mentality. They said one pip could mean anything. Yeah, one pip could mean a standard lot, which is $10, or one pip could mean $20 if it's two standard lots. If you're trading 10 standard lots, one pip could be $100. This is what, this is what lured us into the game in the first place. That one pip could mean anything. So, and then together with that was that you can make it in 5 minutes. So the 5-minute chart and the 1-minute chart came to play. So we all have that still innate, we're still thinking about trying to, how can I just get it done quickly? Yeah, quickly. So to conquer that, I don't leave it out completely. It's still an allure for me. I still like the excitement of it, but I use the scalping on the reasons I just showed you now. Yeah, when it's against my fundamental bias, but the setup is gorgeous. The other thing is when we are so close to the target and the setup occurs, I'm using the scalping mode. I'm lowering my risk and I'm going for something a little bit more than 1:1 on a single trade, single position. Yeah. And then to what we are doing. Yeah. We want those bigger waves. I was going to use Babe Ruth here as well. He's looking for that massive home run. So when do I use the usual sort of risk, and what is the usual sort of risk for me? So we're going to use multiple entries here. 3. Yeah. So we are going to use 3 entries for our risk, for our standard risk. So if you are trading one standard lot, and then using this method, you are going to be trading 3 standard lots. However, that 3 standard lots is not more than your percentage, 0.5%, whatever. We're probably gonna have to use lower here because the account sizes are a bit smaller. So we're going to use, what can we use? 0.01, 0.01, 0.01 instead of 1 standard lot. So that all of that equals 0.5%, your maximum. This here is your lot sizes. Right? So the idea is 1/3 plus 1/3 plus another third of your entire position is entered there. Right? So what we're doing with this one, this is the second variation. I'll show you the first variation after this one. So what you do is you enter the trade here, and you're entering 1/3 of your position thrice. Yeah, let's say 0.01. And then once the trade hits here, you're taking out 2 of your position. So 2/3 are removed from your position in this area. Yeah. So which means by using 1.5, this becomes now your risk free. Now from here, if you have moved your last third up to break even here, up to the entry point, then this whole thing becomes risk free. So the other third continues to go up until the markets decide to turn against you. So it's this third that makes the money for you in this scenario. Right? Does everyone understand that? Just let me know quickly. Do I need to go over this again. Okay, Mayu, I'm going to go over this again and then also rewatch the video on this one. We're going to use multiple entries when we are doing this sort of trading. Yeah, when we are doing surfing. Yeah, when we are doing our standard sort of trades, then we're going to use multiple entries. We're going to use 3 entries, 3 positions, and they each one equal in size. So it's going to be a third and a third and a third. So we're going to enter 3 positions here. And we're not going to do anything with our position until 2 of them, until our price hits here. And when price hits here, we're going to remove 2/3. We're going to close that off. Then when that happens, then we are risk-free. So this is a risk-free situation at 1.5. We're removing the first 2 of that. Now we still have 1/3 of our position running. And that 1/3 there is really what makes us the money. Before it hits this, you are risking. And then it's still, just a whole 50-50 scenario sort of a thing. Yeah. Obviously, our edge is at play, so we have a better chance of it happening than not. But if this was 1:1, then the chances of it hitting here is higher. And as we're looking for more and more pips here, the chances of it hitting there, it just statistically gets lower and lower as the higher our targets are. Yeah. So this one variation is, I think Marcus using this now. Yeah. Marcus using this variation, the second variation. So we are taking 3 entries and we're taking 2 of them off when it hits here, when it hits the target. So it means that if you've moved up to break even, then you've got a risk-free third of your position going. And then you can either trail that last third underneath the areas where we are stop loss, or where we can place our stop losses. And then it even hits our target, then we're still trailing that last one until we eventually get knocked out. But this is what we are really after here, because this is the thing here that's going to grow the account. It's that. As we are risking, yeah, it's just, we risk. We were comfortable with the amount we were going to lose here. If we were going to lose, we were comfortable with that. But once it hits here, we are risk-free. There's where we are trading. It's this. Once it hits that area, that's when we are really trading. Right? Perfect, Mayu. So Mayu came late and I explained it, and that means that my explanation was an understandable one. Right, so next that's our second variation. The first variation is this one. It's also multiple entry, but we are risk-free only once we hit 1:2. Now the difference here, you are still taking multiple entries. You're still taking 3 entries. Yeah, you're still taking a third and a third and a third, right? But the issue here is that you're taking 1/3 off the table here already at 1:1. So now you have your 1/3 off the table, and then you let the rest of them run, right? You let another third run. When the 2 positions, that one is taken off the table. So now even if prices comes up here now and it turns against you and it hits your stop loss, you only lost 1/3 of your entire risk. So you risked a certain amount, but if it hits here, you don't lose the entire risk. You lose 1/3. Or is it 2/3? Yeah, you lose, sorry, you lose 2/3 instead of an entire amount there. Yeah. So instead of 9 pips entirely, you lose 6 pips, whatever, entirely. Yeah. So now prices gets up to 1 to 1:1, you take 1 off the table. And if it gets to 2:1, if prices gets to 2:1, you remove the other third, and then it becomes risk-free here at 2. You have a risk-free situation at 2. Then your last third, again, your 1/3, that one is the one that makes you the money there. And the idea here really is to not move stops and stuff at least until it hits there. Because when it hits here, yeah, if it doesn't hit here and you lost, you can either lose your entire amount that you've risked, or you can lose 2/3 of the amount that you've risked if it hits that first. But the acceptance of this is what is important. Just accept this and let it go irrespective of what happens, so that you can eventually test this. Because as prices, let's clear up this. Does that part make sense, people? Do I have to go over the first variation, which is risk-free at 1:2? Do you understand 1:2? Okay, I'll go over 1:2 again. Yeah, Glenn? 1:2. Okay, so we are taking 3 entries here. Don't worry about that now, Andy. We're going to do that later. Because you don't take the trades if your targets aren't there initially. This is the practical part of how it's going to work. Right, so we're taking 3 entries, and they are there, 1/3 of a position. Yeah, this is your entire position. So you're taking that here. Yeah, so you're taking 0.01 plus 0.01 plus 0.01. Yeah, so in actual fact, you got 0.03 amount of lot size. What matters is that all of these mustn't exceed your initial risk that you've already decided you're going to risk. If it's 1%, yeah, if this is your risk, accept that. Yeah, because when you risk, you are telling yourself, I might lose that. I have a chance of losing that. Yeah. Okay. So now you take your 3 positions, and then you take your first one out. You take 1/3 off the table when it hits 1:1. Yeah. So 1/3 is off the table. So prices has gone up. Hits the 1/3, you close off 1 trade. So you've got 1/3 in your pocket. Yeah. Then you take the next position off when it reaches 2 times your risk. Which means that in this case, you would have had all your risk cleared now. Yeah, you will have no more risk on the table when you have, because this is banked, and now you're going to bank another third up here. But this third is actually worth more because it's now run up to, instead of 10 pips taken there, you've taken now 30 pips up there, because you're including that. So you've got 2 off the table at this point. Yeah? Let's see. Yeah. So you have 2 off the table at this point, and then you still have 1/3 to run. Yeah. Now you have 1/3, and that's the 1/3 that makes the difference in your account growth. It's this final position that causes the growth in your account. While you are still at risk, that's nothing. It means absolutely nothing. It's this that matters. Yeah, to be consistently a profitable trader, this last section is what grows the account. Okay? Right. So that is our variations that are of how we risk. Okay, so how do we actually do this now? So we found ourselves in a situation where we are at an area and everything is working out for us fundamentally as well. So you want to risk your full amount, 1%, for instance. So you don't risk this. You don't even start that if your target isn't at least twice as much. You don't even bother looking at this if your target is not twice as much. Yeah, you skip it. It's a rubbish trade. Yeah. You can do it with a scalping situation. If your target is down here, then you lower your risk and you take your profits at 1 point, just over 1 point, 1:1. Yeah. So what you do is you enter the trade in the perfect scenario. You have your everything in line here. You have enough room to move to your next target, and you take your trade there. Yeah. And then you're taking your 3 positions there. Yeah. And then prices are moving up and up and up. And then when it reaches 1:1, this is first variation. Then you take off your third there. And it goes even further up now. And then you take off your your second position when it reaches 2. So here you are risk-free. And then hopefully when it gets to this point, you still have one that keeps on going. And then that is the one that makes you the money. Okay, let me just go to a chart here. Is everybody cool with that explanation? Yeah. Let me know if you have this tool. I don't use MetaTrader, but for demo purposes and all that, then I need to show you what's going on here. So I'm using something called Easy Order. Yeah. So let's say, for instance, we are, and if you don't have this and you want it, just let me know and then we can sort this thing out for you. It's free. It's called Easy Order. And let's say here we have an example now where euro versus the yen. I'm short this pair. I don't want to buy. Yeah. So which means I'm going to do a scalping sort of a situation here. Yeah. Let me clear this up. Yeah. Don't want that. So what we have, let's look at our top-down approach sort of a thing. We got our weekly. We have some lines here, there, and there. We're just going roughly here. We're not going to go perfect. And then now we have this, and let's say prices are coming down now, right? that is a support level. We can adjust the lines here. And then if we look at that there as a support level near to price, so we have that on our daily. For 2 days, prices has been coming down. And here we have like a break of a static trend line sort of a thing, and prices are coming down. Is there a way of identifying price coming down? Looks very good on the hourly, so we would want something like this, right? Okay, so let's just leave it at this in the meantime. So we have a potential target. Let's say this was a nice level. Yeah, let's just say this was a nice level. We go to our 15-minute chart now. Let's say that this was a perfect level. So now we want to use this easy order thing, yeah, to get ourselves into it. Let's say this was a perfect level and it looks like stop hunting central over here and everything is just perfect. So now you want to take a new order. And what do? We're always doing stop orders. It's either a buy stop or a sell stop. We're not really placing limit orders. We are taking a buy stop, and then we have all our lines in there now. Yeah. So this yellow line is where the prices are, where we want to take the trade. So prices are there now. So let's say if this setup happens, prices are up there. It will go up there. Yeah. So I'll move that up, and I move my target up there, and my stop loss down there. Right. Let's remove this. Right. So now we have our potential orders in. Yeah. So that is now. And I want to scalp the market because it's against my fundamental and all of that. So what I'm doing here is that from the entry to the stop is about 40 pips, which means I want something more than 40 pips. Yeah. So 41. So then I will look for a little bit more and say, okay, that is my area. And then I would say submit the order there and there. That's the way we do it with this thing. And if you were going to do 3 orders, then it is a new order, another buy stop order there, and then these are my lines again. I move my lines to where I want it to go, like this. And then I just submit the order again. But the cool thing about this is you can risk here. So you're saying that your risk is 1%. You put 1% in there, and then you say new order. You want another buy stop. The lines are all coming up there. You move it up, and this is how you do that there. And then you submit the order, and then you say yes there. Now you got your 3 orders in, and then you just leave and you go home. Yeah, or you move your things. Hey, look, I'm not too happy with this. I want the price to come to there first, or whatever you do. Yeah. So I just wanted to quickly show you how you can do it nicely with MetaTrader. Yeah, and you want to close all the orders. You say close the order, close that one, close this one. Something like this always pops up here. Yeah. And then close that order, and then boom. So now all the orders are closed. And if you want to do a sell, then it is just a new order there, and then you always doing a stop. So it's a sell stop. The lines comes up. Your yellow line is your entry, your red line is your stop loss, and your blue line is your targets. And then you will just say submit your order. Yeah. So if you want that tool, then we can sort that thing out just so that you can be better off with the risk. So if you are risking a certain amount, then you just put the risk there, 0.5. Or if you have a better tool, let me know, as long as it's free, so we can give it away to all the guys in the group here. But this one is the best free one that I've found so far. Yeah. Quinn says he's using it, so that's great, and he's not finding any issues. I know that Justin is also using it. and none of them are finding any issues with that sort of a thing. Yeah. So yeah, that is it, guys. Do you have any questions with regards to risk management? Andy, are you using the risk management thing? Yes. Okay. Yeah, the beginning is basically the same as what we did before. So it's just this last bit that I included here to show you a little bit of the inner working of the way I'm actually using my risk plan. So the standard version of this risk is going to be where you are taking 1:1 profits at 1:1. Let me just get back to that. Let me just get back to this. The standard version of this is this one. This is the standard risk. You're taking 3 positions at the bottom here. Yeah. Let me just get this. Where is it? 2, 3. You're taking 3 positions here, and you're taking the third or the one of them off the table when it gets to 1:1. And then you're taking another position off the table when it gets here. And then you let the final one run. So it's up to you whether to use the standard risk-free version. Yeah. It's risk-free at 2, and the other one is risk-free at 1:1.5. This one is at least you're banking some profits. Yeah. At least you're banking some profits as it gets to 1:1. You feel because your win ratio is higher at 1:1. So you feel like a winner. Yeah, you're feeling like a winner. Maybe this is your personality, and maybe you need to feel like a winner. Yeah. Whereas if you're aiming higher up here too, yeah, the chances are lower that it's gonna get to 2. Yeah. That's just the statistical nature of this. But if it gets to 2 as little times as it does, your chances of that happening is high. And if you let this occur, then your account grows. When you let this occur, win. Yeah? Then you feel like a winner. But I don't know really if you're making money in the long run. And I don't know what the goal is here. I need to cater for people who wants to feel like a winner, or people wants to make money trading. Nothing wrong with this idea. I used it for a long while, and I still sometimes use it. It depends. I am either using that version, variation 1, or I'm using the variation 2, which is I'm risking not taking money off the table. What am I doing? I'm risking not taking the money here at 1:1. Yeah. I'm keeping the risk on the table until it hits 1.5. So it's obviously higher chances of losing statistically. It might just never get there. And it got to 1:1, and then no, I should have taken it off at 1:1, sort of a situation. But here you take off both. You take both off the table. Yeah, you're taking 2/3 off the table when it hits there. You've got no profits banked yet, but you still have that third. So it's up to you on what you want to do, and that's what needs to be included in the plan. And then the scalping situation is take anything more than 1:1. See, I want you profitable, yeah. And I know that you will be profitable if you take at least a little bit more than 1:1 when you scalp. Yeah. And this risk management strategy, it works. Yeah. Difficult to stick to it because you always you always feel sad when it reached 1.1 and you never took anything off the table. Hence the reason for the first risk management idea, which was the one that I just showed you now. This one, where you at least you're taking off here and you're feeling like a winner early on in the game. What you do with the remaining positions is also another thing. I'm trying to make it less complicated by giving you the structure already to work with. What I do is I don't do anything until it hits this green level 2, because that's what I've risked. Yeah, I risked this portion, and that's just it for me. And I'm risk free when I get here to the top. Yeah, so psychology plays a massive role with risk. First, you need psychology sorted out, and then your risk management. Do you have any issues there? Any questions on that one, guys? Let's see. Yeah. We'll rewatch. As long as you're not overcomplicating this issue, because whatever it is you're risking, just stick to that and look at the chart and already know if you're in what mode you are in. Are you in scalping mode where you're taking 1:1 a little bit more, or are you in your normal standard mode? Yeah, taking your general risk. And I am dropping my risk as it's going down the time frames. Scalping can be for normal chart as well. If you are, like I explained before, when I explained this, let me go back to the chart here. Yeah. So now you are at your normal, you are doing your normal thing. Yeah. You've taken your trades normally. Down here at the bottom, you've taken your trades, perfect trade. But now the issue comes in, you are so close to the target and prices are trending here. Now you can scalp that situation there, because that target is so close. You are looking for 1:, a little bit more than 1:1 there. So you can scalp whenever you are in scalping mode. Yeah, you're already dropping down your risk. Scalping mode should really be just for fun. We still want this element as well. So do it in a safe environment. Do it at a low risk. And do it wisely. You're not expecting this thing to shoot up. You took 20 pips, but you want to make 5,000 pips. Yeah. Just accept that's your target there. Just accept that when you are so close to your targets. Yeah. So the homework for this is, like, for everyone now, is to complete a trading plan that includes what it is you're going to be risking per trade, and use these variations if you want. Okay, that is the story for me, guys. I will see you in the room there, and this will be this has been recorded, and the course is going to be ready soon, and I'll let you know when that is.
That sums it up.
Let's see if we have any. Perfect. Okay, thanks very much for your time and for watching. And I will see you in the room. Yeah. Cheers, guys. Bye-bye.